Dana, first of all, what you hear from CEOs, I think, is a little shocking. What percentage of CEOs are expecting a recession in the next 12 to 18 months?
98%. And that's up from roughly 95% earlier this year. And CEOs have been signaling recession since the springtime in our surveys.
What is causing the recession? And I wonder, is this something we're almost talking ourselves into? Because if you think a recession is coming, you're going to cut back on spending, whether you're a business, whether you're a consumer, or is this the Fed's doing?
Well, I think a lot of it is interest rate tightening by the Fed. And again, the Fed is trying to tackle inflation and to keep inflation expectations anchored. Our own measure of inflation expectations is quite high for next year. And certainly consumers are starting to worry about their personal finances. They're hearing bad news about companies, and they're concerned about their own job prospects.
And Steve, what the consumer is thinking and doing as a result is something that you've been tracking pretty closely with your latest survey.
Yeah, undoubtedly, inflation is weighing on the consumer. Negative views on the economy are weighing on the consumer. And as we talked about in the last half hour, offsetting that is 4.3 million more employed Americans. But I want to go back to these CEO surveys, which I think are so interesting. I think a lot of the downbeat views of the CEOs can be laid directly at the feet of the Federal Reserve, not because they're not because of the rates that they're raising to, but the uncertainty around the effects of it. If the Fed had gotten its act together and raised rates sooner and come off of the pandemic era stimulus sooner, it wouldn't have to be so aggressive. So if you're in the C-suite right now and you're trying to game out next year, you just don't know what it means for the economy to have endured 475 basis point rate hikes and the idea that they're going to go probably another 50 next week and another uncertain amount next year. It's that uncertainty they probably could deal, I would suspect, with a rate if they told them what it was and you could game out what the impacts would. I'll give you an example. Right now, you listen to David Solomon from Goldman Sachs, and he's girding for a tough year next year. At the same time, his own economists are saying the economy skirts a recession and, in fact, has a soft landing or a modest soft landing and not a recession. So, but if I'm David Solomon, I think I'm probably girding for a recession next year.
Why? Because
the risk is like every CEO has to solve this problem, which is there more risk leaving business on the table and not having the people in place, or is the greater risk having too many people? And right now, of course, there are some bespoke reasons that are going on in the financial industry right now that are not for the entire economy. But in general, I have to think that the risk is to the downside. And so you prepare for that risk because you're better off if you're ready for it.
But, Steve, that's why I ask if this is just a self-fulfilling prophecy of some sort. If you think it's going to be bad, you're CEOs of major companies, in order to prepare for that, because you have to do a risk assessment and say, OK, then it becomes a recession of your own making because you're concerned. Same thing with consumers if they're going to spend less.
If Paul McCulley were here, he'd give us a lesson in the paradox of thrift, the idea that the very actions of CEOs to prepare for a recession, to do what they think is right by their company, creates a negative impact on the overall economy. And by the way, this creates another risk we maybe don't talk enough about, which is if you do have a recession, classically, the Federal Reserve or the financial authority or the fiscal authority would step in. That may not be the case next year. It could be the case that because the Fed is more concerned about inflation, because the Congress is more concerned about deficits, that they're not able to help in ways that they normally can during a recession.
That's like the arsonist putting out the fire, Steve. A lot of people would say it was the stimulus that caused the inflation, which caused the high rate, so that might. But I think recessions are always, it's almost always self-fulfilling. And then, stock market goes down, then you feel like you got less, and then you don't spend as much, and it's just like one big vicious circle. That's why the Fed needs to be so careful. They can just talk and maybe do everything or accomplish everything. I'm back to saying that they should be getting near a peak, Steve, because all the jawboning and all the self-fulfilling prophecies and David Solomon, he gets to cut bonuses. Why wouldn't he pretend there's going to be a recession if you can,
Because he risks losing people. I think Dana could probably talk at length about what's going on in the job market right now, which I think has had some loosening,
Steve,
but still remains pretty tight.
You don't risk losing people if everybody's doing it at the same time.
Exactly.
Fair enough.
It's the rainmakers who aren't, Anders says, are still making $10 million a year.
Dana, that gets us back to the question of if there is a recession next year, how deep of a recession will it be? How serious? How do you go about trying to game that out?
Sure, we think it's going to be short and shallow. And we're already starting to see slowing in the economy due to interest rate hikes. A lot of it's in housing activity, which is where you'd see it first. And we're also seeing consumers shift their spending away from goods towards services, but we think services will probably be under threat. Certainly, when we look at expectations, they've been signaling for a recession for a long time. Consumers are less sanguine about consumption, and certainly consumers are they're still getting pummeled by inflation, and we're seeing expectations weaken across the board, especially in that middle income group, those folks who don't necessarily get the services and also aren't wealthy and don't necessarily have a lot of excess savings. So we think that this is going to be a function of slowing consumption, but also housing and also business investment.